Okay, so I think that we can start. So good afternoon to everybody. I'm very happy having today John Fell, that is the Deputy Director of the General for the Macroprudential Policy and Financial Stability at the European Central Bank. He's the co-chair of several international working groups, including the Eurosystem Macroprudential Policy, and as well as the European Systemic Risk Board, and is also part of the ECB Financial Stability Committee. And among various other things, what I think it is very interesting to know is that is, in some sense, the director of the ECB Financial Stability Review since 2004 when he introduced it. And, you know, we're very pleased to have him today presenting to us the last report, the ECB report on financial stability. So, John, the floor is yours. Thank you very much.
Thank you very much, Loriana, and thank you for that introduction. Yeah, I've been doing this a long time. I hope not too long. Let me first thank you for your invitation to come back and present the highlights of this issue of our FSR. I think it's the third time now that we've done this, and it's the third time to do it virtually. If we do it again, I mean, I'm being a bit forward there, but if we do it again for the November issue, I hope that we could maybe do a physical event so that more of...
Or we can do hybrid. That's the...
Or a hybrid event, so that,
yes.
So that more of my colleagues, you know, this is not a one-man show. I mean, there were a lot of people involved in this, doing the analysis and the drafting, and that they could join. Actually, some of them are on the line today, and if your questions get too tough, Loriana, I might call on some of my colleagues. I saw Tamara there, for example. But before I get into the substance, I think it's worth noting that events have been really moving very fast since we came out with our financial stability assessment last November. You might recall then that our message was one of both good news and of bad news. The process of adjustment to the global supply side shock that had been unleashed by COVID-19, the pandemic, had been a cause for financial stability concern. But we were also hopeful that the end was in sight, that social restrictions, etc., would be lifted, and you know that we would be normalizing. But since then, geopolitical risks have come to the fore, and we're now having to deal with the consequences of the Russian invasion of Ukraine, which of course has had unspeakable humanitarian consequences. But it has also created new challenges for what, in our view, was an already difficult financial stability outlook. Also, the FSR was published 3 weeks ago, and we have had some financial market moving events since then. So I could just mention we've had higher than expected inflation in both the euro area and in the US, and we also had a meeting of the ECB's Governing Council, of course. The outcome of which I'm sure is well known to participants on this call, but I could still say, qualitatively speaking, and maybe anticipating questions that might come later, I think that these events have left our qualitative financial stability assessment intact. Of course, we didn't know what the president would be announcing last week. So yeah, I mean, we're continuously revising and updating, but I say qualitatively our assessment remains intact. So against that background, I think we can go to the next slide. It's probably not a surprise that our headline message this time is not an upbeat one. It's there at the top of that slide. We think the financial stability outlook has deteriorated since last November. And this is for several reasons. I mean, the FSR is extensive on the sources of risks and vulnerabilities, but 4 of them are here. And I think it's maybe first recalling, and it's going back to the assessment that we presented back in November before the invasion. We did have concerns about the building up of vulnerabilities. And we saw vulnerabilities building up in the financial markets. We had concerns about asset price misalignments, for instance. We also had concerns about dynamics in the housing markets, interaction between rising house prices and growing mortgage credit, and on corporate sector balance sheets as well, because I mean some corporates, of course, as we know, were hit hard by the COVID-19 shock. Others did better, but we came out of it with some vulnerabilities. I mean, especially those firms that replaced revenues. I mean, they had to pay their bills by going to banks and increasing their indebtedness. Now, as the war had led to higher inflation and lower growth expectations, I mean, our assessment now is that many of those vulnerabilities have been, there's not only are they still there, but they have amplified since November. And then at the second time, I mean, a bit expanding on what I said about vulnerabilities in asset markets. I mean, we had been saying for a long time that financial asset prices, we were thinking mainly about equities, but also corporate bonds. I mean, they were difficult to reconcile with the fundamentals, and that, of course, made them vulnerable to correction. And with interest rates now rising, both long term and in the US also short term, and soon in the euro area as well, those fragilities are being exposed. So I think it's hard. It's not controversial to say that a correction is now clearly underway in the US. In fact, yesterday I think it crossed the magic threshold to become a bear market for the US equity market, and of course that spread also to the euro area markets as well. So we do see fragilities in the asset markets. And third, after the stresses that the pandemic imposed on basically all non-financial sectors, rising interest rates and input costs, and here I mean especially energy, but also non-energy commodities, those input costs, I mean, of course, have an impact on the profitability of firms, and it's likely to test the resilience of balance sheets going forward. And then just a fourth point. Now, I mean, I think we've all been pleasantly surprised by the resilience of the banking sector through the pandemic, and now the war in Ukraine. I mean, it turned out that there were some exposures, but they were limited and they were manageable. But we think we now have a kind of a deja vu on the outlook for the sector. So, I mean, profitability did recover; it bounced back strongly. But we think now, especially looking at the figures for some of the larger banks in the first quarter of this year, we think that recovery in profitability could be stalling. So arguably, we're back to where we were in late 2019. And so one of the risks to financial stability that we were flagging then was concerns about low profitability. They were very much front and center. And of course, one of the reasons for that, why we have concerns about profitability in the banking sector, is because that has a bearing on banking sector intermediation capacity long term. If banks are not growing their capital organically, then it's a problem for financial intermediation. And then we think that banks may also have to deal with new asset quality challenges. I mean, some of them related to the war, direct, indirect, and I mean, everything that is happening to the non-financial sector can have implications for the banking sector, to the extent that the banking sector is exposed to those businesses. So going to the next slide now, and the chart on the left here is showing that the consensus now, the latest figures that we had in the FSR for May, the consensus among professional forecasters was for lower growth this year, and also for higher inflation than was the case just 6 months before. So the outlook that we had at the time of the last financial stability assessment. Now, not only that, but forecasters seem to be more certain about this. You've got a narrower probability distribution for growth there. And then you can see the probability distributions for inflation. They don't even overlap. And so the war and its knock-on effects through the sanctions, etc., on energy and other commodity prices, I think, I mean, they were an important driver for the supply side shock that I think we're adjusting to now. But I think it's also important to recall that it wasn't the sole driver. And if you look to the left of the chart on the right, And if you look to the left of the vertical line that is labeled invasion there, you can see that both energy and other commodity prices had actually been rising well before the war as aggregate demand was increasing. So in a way, the war amplified a trend that was already underway. And even without the war, slowflation, if I might call it that, was becoming an issue for the financial stability outlook. Now let's go to the next slide, and I'm going to go through this one in reverse order, starting on the right, because the chart really underscores a financial stability concern that emerged at the outbreak of the war, a new financial stability concern, a distinguishing feature even, and it was on account of unprecedented commodity market volatility. So, I mean, against the background, we had the initial reaction was concerns about global shortages for commodities, given the role that Russia plays in global production. Global shortages, commodity prices surged, and that created risks for commodities derivatives traders, but also for energy producers and for other participants in the commodity markets. So you can see a surge of price volatility for natural gas futures there on the right, we actually saw that same pattern across several commodities at the start of the war. I just put this one up as an example. And as that volatility surged, that meant that participants on derivatives markets, a risk management instrument that will be important in the entry into a contract is the initial margin. So that's the collateral that needs to be posted on entering into a contract with a clearing member of a CCP. And you can see there, it's the yellow line, that shot up as well as volatility in natural gas futures went up. And initially, we were hearing from market intelligence that those requirements were actually reaching prohibitive levels. So that it meant that, and prohibitive to the point that it might have even made it difficult or even impossible for some real economy participants in the market to hedge. So say, for example, a natural gas company that would want to sell natural gas at a pre-agreed price in the future. So basically taking a short position, it mightn't have been able to execute that trade if it discovered that it had insufficient collateral. So of course, that's all about liquidity management on the side of non-financial market, non-financial corporations who may not ordinarily be having to manage these kinds of risks, certainly smaller firms. And that could have left, say, an energy company then exposed to market risk, and even the possibility of ultimately credit risk. Now, we explained these developments in the FSR in quite some detail, but we actually didn't have the full picture when we were finalizing the draft. So since the publication, we've actually managed to access and analyze granular data on derivatives transactions. So that's data that is gathered under the European Market Infrastructure Regulation, or the so-called EMIR data. And this actually allows me to tell a bit more about this event than what is actually reported in the FSR. I think it's important because we were kind of, it's almost like, an episode in a series where we left a cliffhanger and there was something, there were more developments, and we were able to look at that. And I think the key point is that data allowed us to confirm that both non-financial corporations and banks as sectors did face sizable additional marginal requirements in the fortnight after the invasion. For some non-financial firms, the additional liquidity needs, could have reached as much as 10% of their annual sales. So these are not small numbers. And that, if they didn't have available liquidity, that could have caused problems. But subsequently, as commodity market volatility subsided, and you can see that that's what happened on the right, those liquidity needs, because margins started to come down, subsided as well. Now, at the same time, we had concerns that commodity market functioning had been impaired because we did see a drop in open interest on commodity derivative contracts on one of the exchanges where that activity takes place, the Intercontinental Exchange, or ICE. So that we thought, well, the question was, where was that activity going? And there was speculation about where it might have gone, or whether indeed that activity was, whether firms were even hedging. But it actually turned out to be a partial view, and this is where we're grateful to the EMIR data, because in fact, open interest on the European Energy Exchange, so it's another exchange where energy derivatives are traded, so the EEX, that actually rose at the same time that it was declining on ICE. It could have been, we don't know for sure, but it could have been because the EEX was asking for lower initial margins than ICE, because their margining model was less sensitive to the high frequency movements in the price. But actually, when you add open interest on the two exchanges together, we actually found only a limited temporary drop in activity. Now, market intelligence at the time had suggested that some entities could have either shifted their activity to the OTC markets. We would have had concerns there because risk management standards are usually lower in the OTC markets, or, as I mentioned, even scaling down their hedging activity altogether and leaving those energy firms exposed to market risk. Now, that could well have happened maybe during those initial 2 weeks. But if it did, it appears it didn't persist for long, because open interest on the natural gas futures recovered. So overall, now with some hard data, I mean, our assessment now is that we see limited financial stability risks here. But the incident, I think, it still raises some issues about margining practices. So the differences between the exchanges, and also the liquidity preparedness of market participants. And I mean, this issue, I think it made it into some of the main international financial newspapers. So it was a prominent issue at the time. Now, of course, at the same time, while all of this was going on, and let's not forget about the left-hand side chart, we did have more broad-based market reactions to the war. It's not shown here, but the stock markets tumbled. But as seen on the chart here on the left, corporate bond spreads widened. Although again, I mean, nowhere near to the extent that we saw at the beginning of COVID. Now, if we go to the next slide, and still sticking with this theme of disorderly market dynamics, I mean, one thing that we saw was the usual pattern, the pattern that we almost always see during episodes of market stress. We saw safe haven flows to the US bond market. You can see that there in light blue on the far left. But we also saw inflows to asset managers specializing on euro area inflation protected bonds as well. Now, at the same time, so corporate bond funds, both US and euro area, suffered outflows. And then, as you can see in the middle, equity funds that were focused on businesses that would have stood to benefit from higher energy and other commodity markets, they actually drew inflows. They're above the zero line on the middle chart. Now, importantly, I mean, you can see a lot of activity going on there on both of those charts on the left. So there was a lot of flows and reversals of flows, but they were in the main orderly, and we didn't really see suspensions on outflows or anything like what we saw at the beginning of COVID. Maybe there was, well, I mean, suspensions was one exception, of course, and that was for funds that would have been more focused on Russia, where, as you might expect, there were some issues, but they were not. Those funds are not so large. Now, all of that said, and the fact that the sector, the non-bank, the investment fund sector, also showed resilience. as we've repeated many times before, we do see vulnerabilities building up in the euro area investment fund sector, and you can see some of that on the right. We've got both. We've got a measure of duration and a measure of liquidity risk there. So duration, so that is the exposure in interest rate exposure rising, and liquidity risk. So this is the ability of, let's say, funds to have sufficient cash on hand or cash-like instruments on hand to honor unusually large redemption requests if they come. And so, I mean, the lower those liquidity buffers are, the greater is the risk that the funds can't meet it out of cash. And if they can't meet it out of cash, then, and if they can't, say, get cash from other sources, then you could be getting into forced selling situations. But that is I mean, it is an issue where we think that the probability of it increases as that liquidity buffer declines. And then not shown on the chart also, I might have had it last time, Loriana, but last time exposure to credit risk has also been increasing in the sector. Funds moved down the credit quality spectrum, in part in a hunt for yield. Higher yields are available on corporate bonds, for instance, with lower ratings. So putting all of that together, I mean, we do continue to consider it plausible that the sector, the investment sector, is vulnerable to forced selling dynamics should it be overwhelmed by a shock. Now we go to the next slide, and beyond the market impacts, we also see potential for rising credit risk in the corporate sector now. The left chart is plotting some scenarios that Moody's produced for default rates on speculative grade corporate bonds. 2 years ago, actually, at the start of COVID, they produced charts that looked very similar to these, and at least qualitatively, there was a downside scenario which had the possibility of having a surge in default rates, and we found that plausible at the time. Now that worst case scenario, I mean, it could well have happened had it not been for the massive public policy support that the corporate sector benefited from at the time. And so, I mean, we had the combination of easier monetary policy and the relaxation of capital requirements, both macro and also micro, and that kept credit flowing on favorable terms. Now, I think we may not have realized the potency of an instrument that had never been used before on a mass scale, and that was, of course, the government guarantees of firms' liabilities, and that also, all of that packaged together meant that we didn't get that adverse scenario, but we got something that was actually better than the baseline, and might have even been better than the most optimistic forecast. I can't remember. But those programs, I mean, importantly, they've largely lapsed now, and the sector has been confronted with a new shock, the war in Ukraine. So we just take the baseline, the yellow lines. But by the end of this year, you can see that Moody's is projecting sub-investment grade bond default rates to be double what they were at the start of the year, and then the pessimistic scenario is showing a lot worse, so multiples of 7 times, 8 times. So at this stage, our view is that the impacts, both across sectors and countries, notwithstanding all of that, are likely to be heterogeneous. So the chart on the right here is our attempt to identify those sectors those subsectors of the euro area corporate sector that have suffered from what I would call a double whammy of both the COVID shock, which caused turnover in some of those industries to collapse. As you can see, the numbers are there on the y-axis, and have now found that their businesses have larger than average exposure to energy inputs. So that's traced out over the x-axis, and you can see there we've got the highlighted sector is the double whammy zone. So those are the sectors that have been hit by both, and the usual suspects are there: air transport and food and beverages. And then you've got a few that are sitting very close to that vertical axis. So those are the sectors that we could have some concerns about going forward in light of the rise of energy prices. Now, if we go to the next slide, I'm going to turn to the whole issue of sovereign balance sheets. And after the COVID-induced accumulation of debt, it was well known that a scenario of weaker growth together with an inflation shock, so again, that slowflation scenario could expose sovereign vulnerabilities. And now we're also seeing increases in budget deficit projections for the vast majority of euro area countries. And of course, that's contrary to the earlier expectations that we would have seen in normalization after COVID. So, I mean, as you can see on the left, and against the background of asset purchases coming to an end and monetary policy interest rates now expected to rise, we're seeing a widening of spreads, and by more in those countries with high debt levels than the ones with low ones. So we've separated there between the ones that have above 90% GDP and the ones that are below 90%, and you can see that the slope is different, and well, both the slopes and the slope and intercept is different for the two. Of course, now we've had further widening since the Governing Council meeting last week. And I mean, we had been hearing in our market intelligence, for example, concerns about fragmentation risk. So that's the risk of spreads widening, possibly even by more than the fundamentals would justify. Now we really, we aim for a balanced assessment on this in the FSR, and we state a number of the mitigating factors. And of course, one of them that I think is very important and shouldn't be overlooked is the whole issue of the reduction in rollover risk for governments who took advantage of low interest rates to extend the maturities to extend the weighted average maturity on their debt. So those rollover risks are lower than they might have been in the past. But we do look at this whole issue in quite some depth. I mean, how risks on sovereign balance sheets could be a source of risk for, more broadly for financial stability. And we show the results of some simulations of how rising interest rates and also falling growth potential could impact sovereign gross financing needs. So that's the indicator that is shown on the right there, gross financing needs. And again, we separate between countries with debt GDP ratios that are above and debt GDP ratios that are below that 90%. And I mean, you can see a combination of scenarios there. So we've got an interest rate rise of 100 basis points, and then we've got another scenario with 100 basis points, but in addition, 1 percentage point lower potential growth for the following 3 years. And so, I mean, notably, it would take both an interest rate and a growth shock to set financing needs on an upward path. Now, that supports the view that debt sustainability risks have indeed been mitigated by rollover risks, but it also shows that further deterioration of the growth outlook could become a cause for concern. If it were to happen, it could be a cause for financial stability concern. So even though so far the widening of spreads has been orderly, including what we have seen since the publication of the FSR, of course, past experience has shown us that non-linearities can appear when they're least expected. So that makes us more and more wary about this risk, and its prominence maybe has risen since the last issue of the FSR. Now, if we go to the next slide, and we're dealing with households, and then, as I said in the introduction, the main vulnerability here arises from the interaction between rising house prices, rapid mortgage credit growth, and now the potential for a squeezing of household disposable income, given high energy prices. And you've got some analysis there on the right-hand side on that. But signs of overvaluation had already been rising through 2021, and the latest euro area aggregate data is now showing the highest rates of house price inflation for the euro area in 20 years. Now that's for the 20-year period of the existence of the euro area. It could be that an average for whatever countries could have been members of the euro area before that may have had numbers that were, yeah, I mean, I'm just making the comparison. It's the highest over the last 20 years since the start of the euro. Now it's partly driven, you can see it there on the chart on the left. It's partly driven actually by increases of construction price expenses, which have been soaring, as you can see. It's a red line on that chart, and of course that's got a lot to do with the shortages in commodity markets and so on. But we also cannot exclude that we might be entering into a dangerous house price credit spiral. And that seems to be the case already in some countries. In fact, the ECB had been issuing warnings to countries about housing market vulnerabilities over the past year or so, as you know very well, Loriana. And I mean, some of them took countermeasures, and while those countermeasures have been taken, at an aggregate level, we still see the possibility of price reversals in the market. And if they were to happen, that could amplify and propagate economy-wide shocks. If, for example, interest rates and income squeezes were to cause defaults to rise, or if it were to lead to a consumption squeeze, let's say. There are two big mitigants to this. So again, I mean, we try to be balanced. Two big mitigants to this risk. And I think first, the financial condition of households is generally strong in the euro area. Unemployment is low and savings are high. So we had a lot of savings, as we know, accumulated during the lockdowns. And then a second factor is that fixed rate mortgage lending is more prevalent in the euro area today than it was a decade ago. And of course, that has shifted interest rate risk to the banks. It's a point that I'm going to come back to when I get to the banks on the next slide. And as I already mentioned, we had this striking recovery in profitability, with the aggregate return on equity almost exceeding pre-pandemic levels, and market valuations for the sector rose accordingly. Now, while the sector was hit harder maybe than any other sector by the shock of the war in Ukraine, it proved to be short-lived, and I think that what that did was, I mean, at least for us, our reading of that was that it confirmed market perceptions of a generally resilient sector. Now, that said, price-book ratios for the banking sector remain significantly below 1, and that means that the banking business in the euro area is value destructive at the margin, and that's something that we were saying before the pandemic. And we do think, even though banks usually benefit from a steeper yield curve, this could be outweighed by lower than expected growth. And at the same time, the shift from floating to fixed rate lending brings the concern that, so as I said, that risk has moved from the housing sector to the banking sector, and brings the concern for some banks that are funding low yielding assets. So one could think of mortgages, for instance. Profitability improvements might not actually be possible as interest rates go up. Now, turning to the next slide, and before concluding, let me briefly mention that we have two special features in this issue of the FSR. One of them updates our climate risk assessments. It's actually our third special feature on climate, and the analysis suggests that banks and non-banks alike have exposures to high carbon emitters, which we would consider concerning, with little sign that this exposure is declining. And you can see that on the left. We do see more positive signals from the growth of green financial markets, and although disclosure there is improving, as you can see on the right, we remain concerned about the so-called, what we call greenwashing risks. So, I mean, where instruments are sold, where they're sold as if they have a high green component, that component may not be as large as is portrayed to investors. Now, we think these findings can inform evidence-based international and European policy debates that are going on around climate-related corporate disclosure, standards for sustainable financial instruments, and also for climate-related prudential policies. But maybe more generally, at a time when there really is a lot of uncertainty around government's transitions policies, and especially given the volatility that we have in energy prices right now, we think further investment in the transition to a net zero economy should have a positive impact for medium-term economic growth. Now also, what is becoming a prominent issue, energy security, and also financial stability. The other special feature discusses risks that are arising from the growing crypto asset markets. It's on the next slide, and I think maybe one news grabbing, staggering figure reported this time is that 1 in 10 of euro area households now has exposure to crypto assets. Now, of course, that could be small exposures, but 1 in 10 who are answering these surveys are now saying that they have exposure. What may be more concerning is that crypto markets are becoming increasingly integrated with mainstream markets, and the potential to leverage in the markets, the access to leverage in the markets is increasing. So this could well become a financial stability concern, because we know that systemic risk increases in line with the level of interconnectedness between crypto assets and the traditional financial sector, and the use of leverage and so on. So it's going to be important, we argue here, to close both regulatory and data gaps in the crypto asset ecosystem to mitigate these risks. So I'm thinking the next slide is my second last slide. It's the policy messages that we've included in this issue. And I think the first point to note here, and policy, I mean, we're focused here on macroprudential policy. The first point is that several euro area macroprudential authorities have already started to tighten actually some of their policies. They started doing that before the outbreak of the war in Ukraine. Then at the end of last year, early this year, the economic outlook had revolved around the strong recovery continuing on the back of robust labour markets and gradual receding pandemic headwinds. But as I said at the start, vulnerabilities, and certainly those vulnerabilities that would have what we call macroprudential policy relevance, so where there would be a possibility of macroprudential policy instruments being used to address them, were continuing to build up. And that was especially the case for residential real estate markets. But it also occurred more broadly against a background of robust credit growth and increasing indebtedness in the non-financial private sector. So this would, in our assessment, make a case for building further resilience so that the financial system would have sufficient shock absorbing capacity if a shock were to occur. But that said, it's clear that the war has introduced some uncertainty, and we need to be mindful, of course, of the risks of unintended procyclicality. So what we're recommending to macroprudential authorities now is to really tailor, adapt their macroprudential policy responses to those growing vulnerabilities, but to do it taking account of their specific country conditions. So rather than advocating a one-size-fits-all approach. For non-banks, we're repeating a message that we've actually made many times before, that authorities should address the risks that arise from liquidity mismatch and leverage. I would say that as the risk of disorderly market dynamics rises, so I mean the risk, as I was saying at the beginning, that we think that the possibility of further market correction is there, we think that this message takes on greater and greater relevance. And then in view of what we saw in recent commodity markets and the volatility that we saw, I think it again becomes important to ensure that margining practices don't have unintended adverse consequences. And that's going to bring me to the concluding slide and back to the four main points that I made at the beginning, but I'm not going to repeat them other than to say that our assessment, as I said at the beginning, is that the financial stability outlook has deteriorated. And I think I could stop there, Loriana. Thank you.
So thank you very much, John. And I'm inviting, all the participants to post Q&A in the chat. And, John, you did a great job in presenting all these different aspects. I'm taking the first question that is coming, and I'm reading it. So comparing pretty much, regarding the fact that inflation increase was already seen in the fall of last year, this is something that you stress. The message of the ECB, specifically the chief economist, Mr. Lane, was more hesitant. Isn't it the time for saying we were wrong, as Mrs. Yellen did in the last week?
So, well, look, I mean, I'm focused. I don't work on the monetary policy side of the ECB, and I'm not going to comment on that.
Yes,
yeah.
but you know, the fact that we already, on one side, you confirm what it has been reported, that you know, the increase in the price of let's say energy product and so on, and material, was already starting before the war. So it was already a trend coming pretty much after that the COVID pandemic were over. In the meanwhile, that people are asking questions, I have, of course, several questions, starting from the first one. You know, you're also stressing this as a policy, let's say, suggestion at the end. But, you know, during the COVID pandemic, we relaxed, in some sense, the countercyclical capital buffer. And after this, you know, we have not restored them yet. And the question is it now the time, or in some sense, you know, given that the frequency of the crisis now are so close one to the other, maybe we are not really able to use this type of instrument. What is your view? You know, we were just coming out of the COVID crisis and maybe ready to go back to, you know, to increase again the countercyclical capital buffer. Now we are maybe entering in a new one. So is this an instrument that can be used not so frequently as the crisis we are observing now? What is your view?
So, I mean, I think that there are some quick win possibilities with you know, instruments like the countercyclical capital buffer. So, and what I mean by that is that, I mean, and maybe unexpected, perhaps at the start of COVID, was that we're now in a situation where, when we look at the banking system as a whole, capital ratios have actually, like, actual capital on the balance sheets of banks has actually increased since the start of COVID. I mean, that's in part due to maybe the profitability recovered faster than we might have expected. But in addition, you know, we had this dividend ban. You will remember that. Well, the discussions on all of that, Loriana. So, I mean, that meant that banks, you know, ended up with more capital. So, in fact, I think, you know, it's possible to create what some people call macroprudential policy space, just simply by preventing banks from distributing that capital when it doesn't look like the most sensible thing to do with it. I mean, some banks, I think, a number of banks did announce plans to redistribute capital back to shareholders, either through dividends or indeed through extraordinarily large repurchase programs on shares. And so, yeah, another alternative is to keep that capital and to keep the resilience of the bank. Now, of course, that's an individual business decision. But at the macro level, and that's what I'm speaking about, it should be possible to build those counter-cyclical capital buffers without actually having to increase the amount of capital. On average. So, I mean,
the buffer is present pretty much, yeah. So even if we are in a crisis, or we are, you know, in this situation that is quite complicated, there is space eventually to restore it, because if we are not restoring it, next time we cannot use it again. That's pretty much the idea. The other thing that, you know, your analysis shows is pretty much that clearly the corporate bond yields have been increased a lot. But if you're looking to your graph, it seems that the corporate bond yield in Europe has been increased far more than the one in the US. Do you see any good reason for this?
Bond yields in the euro area have gone up more than, is that the average level? I mean, that's, of course, presumably that's the average
Yes.
bond yield for the euro area, not the German one, let's say. I mean, I think that probably reflects, in part, differential expectations about growth expectations and so on across the euro area, got different sensitivities of economies to higher interest rates.
And still related, because one of the largest investors clearly on corporate bonds are mutual funds, and we get already several times this let's say this picture that the investment sector is fragile. On one side, because it's subject to fire sale, is not maybe able to have enough liquidity buffer. So do you think that we are, from the financial stability perspective, implementing all the instruments that we can implement, and then clearly having this fragility is something that we cannot prevent of this sector, or can we do something more?
So I mean, in this environment, it would seem sensible to have liquidity buffers that would be sufficient to meet redemption requests, for example. I mean, I think one way of doing that is more stress testing. I mean, ESMA does work on this stress testing of the investment fund sector. I mean, I think that is I mean, in a sense, you can see that as a policy tool. It can give you answers on whether or not, whether the sector really has the ability to absorb the shock or not. And so that, I think, is one thing that we could advocate.
And still related clearly to the bond market, the other point that you raise is the sovereign vulnerability. There is a spread dispersion, clearly not even in the graph that you shows, but after, what we observed pretty much from Friday, that, the spread has started to increase after the announcement that, we are going back to a certain type of policy, monetary policy that is planning to increase, interest rate. But given, in your graph, you are distinguishing largely by, the increase in the sovereign vulnerability due largely to public debt capacity. Because, having a high level of debt, it means that if there will be a shock, you cannot intervene to help, and you will have a significant problem. But, how much this is due to really debt capacity, and how much is due to GDP growth and expectation of GDP growth? Which one do you think is the most important aspect?
We're speaking about sovereign debt now,
yes.
Loriana. Yeah, no. I mean, I think that was. I think that is one of the messages that comes out of that analysis that I showed on the slide. But of course, those. Yeah, I mean, there's a kind of maybe a treatment about those shocks as being exogenous ones. And of course, we know that changes in interest rates can have themselves can have an impact on the growth outlook. So they're not exactly independent. That's how those shocks are looked at. But if you get, I mean, I think that the message there is if you get a rise in interest rates, it causes a significant 1 percentage point drop in potential GDP. I mean, I'm not sure that's what you would need a sizable interest rate shock, I think, to generate that. But if you got it, then that would be a scenario where you can see that the path. Gross financing needs are not coming down; they're going up. They're going in the wrong direction, and that will put you on an unsustainable path. That's a shock over 3 years. Of course, if it's potential, it could be longer than that, and and you would price all those expectations back in, and that could be a concerning scenario. But as I said, it's an extreme scenario that we have just for illustrative purposes and to show. I think that, I mean, of the two, it's a growth shock rather than an interest rate shock that would be the more concerning one.
Okay, there is another question by Philippine in this case. You mentioned support medium-term resilience through regulatory enhancement with a point on augmenting the framework for banks. The practice is that the evolution of regulation over the past years has created an administrative burden on banks when they extend credit to firms, slowing their responsiveness, increasing their cost, and thus costs for firms, thus weighing on banks' profitability and firms' growth. Is there a way to take this into consideration now? So pretty much is saying it's not the time to do anything. Just a summary.
Yeah, no, but this is a repeating comment. I mean, I think, you know, I mean, it's usually, I mean, I think that you hear about these additional costs at the beginning when banks are adjusting to the new framework, but after, you know, there's a kind of initial upfront cost to that. But then, I mean, once it's done, then you're dealing no longer with upfront but marginal costs, and those marginal costs are likely to be a lot lower. So, I mean, I'm not sure how big an issue that is now compared to how it would have been a few years ago.
Mm-hmm. Yeah, mostly because, you know, in any case, even if you are increasing a level where they are pretty much largely above, it is not clearly something that will create significant problem to them. Remaining still on the framework of the banks, you know, you were pointing on this chronic problem that we have in Europe of the price to book value of our banking sector. But I was looking to the graph, and it seems that even in UK, price over book ratio is lower. So what is the similarity between the US banks and the UK banks that instead, you know, or tell us why US banks are so profitable then?
Right. I had noticed that as well, Loriana, and I remember I asked somebody at the Bank of England for an explanation, because I mean, there are differences, of course, between Europe and in the UK. I mean, I think our explanation, the ESRB has done a lot of work on this, the whole topic of overbanking, and that, yeah, I mean, it's a crowded market, and on account of that, there's a lot of below cost. You know, there's a lot of below cost selling of products, mortgages, for instance. We had a piece in the FSR on that before. But I mean, the UK banking system is, I mean, it's a bit more concentrated. It's just a handful of banks dominate the market. So I actually don't have a good answer to your question on that right now. It might be, I mean, because I mean, there can be structural issues, but of course there can also be economic ones, cyclical ones. You know, the performance of the economy. I mean, I think also, and I'm just looking at the performance of stock markets over the last number of years, it's also been the case that UK, the FTSE index had not been doing as well as European. And I put that down to lower profitability more generally, or expectations that profitability performances are going to be worse. And if that's the case for the corporate sector, it should be the case for the banking sector too. But I don't know if that's right. I don't know but the structural factors are different to the euro area, so I suspect it must be cyclical.
Yes. Okay. Yeah. You know, then I want to go back to one of the points that you are touching, that is energy costs, and what we are doing now in order to address, you know, this crisis coming from the war, Ukrainian war. You know, and clearly from the financial stability perspective, we are also doing this climate stress test. But you know, what this war is showing to us is that we need to try to reduce as much as possible the European dependence from the Russian fuel. And in general, given that you know, the agenda is to reduce emission, we should go out of, let's say, dependence in general, not just from the US, the Russian oil or gas, but in general from oil and gas in total. However, it doesn't seem that really we are moving that direction. You know, it seems that now we are all trying to figure out how to find, even go back to carbon or all these other things. So if the question is, if not now, when are we really moving to, an economy that will be away from or will use as less as possible oil and gas? And, the shock has been already come out in terms of prices of how high, very high oil and gas. The shock is already something that we see in the economy, is a shock that we see already, or we will see in the loan portfolios of banks. So why we are not taking this opportunity and move out? What is your view?
I mean, I think that's quite right. I mean, the war should in principle, I mean, the impact on those specific commodity markets, the ones that are the CO2 emitting sources of energy. I mean, it should. I mean, I agree with you. I mean, it should speed. It should give policy impetus to speed things up. Rather than delay. Yeah, but I mean, I don't know. It opens up so many issues, not only about how Europe is adjusting to it, but how how other economies, emerging markets in particular, are adjusting also to this change in relative prices of energy. And I mean, I've seen also some analysis showing that. Now with the change of oil prices relative to coal, we could even in some emerging markets face going in the opposite direction, where you get more CO2 emitting rather than less. I mean, because that's not going to happen in the euro area, I'm sure, but I mean, the solution to climate change, I mean, it's not a regional one. I mean, it's a global one. I mean, it's a game that all economies globally should be playing in. But we do our part, I guess, in Europe, and I mean, I think it should speed things up.
No, mostly because it is true that it's a global shock, but we are hit far more than other areas. So from the economic point of view, in relative terms, this should give an even more, let's say, incentive to move away. But instead, it seems that we are largely trying either to find another, again, gas from other parts. I understand that there is a short-term, let's say, we need to have a short-term solution to the problem. But we are not, at least I don't see in the debate, and also in terms of, I wonder, because also from the point of view of the bank loans and the type of activity, if we're not thinking in the medium and long term to solve the problem, this will have potential financial stability problems as well. So,
right. Well, look, I mean, of course, I mean, entering into this kind of discussion, we run a bit the risk of straying outside of the pure financial stability issues. But of course, I think it's an issue that is close to the hearts of many of us. I mean, what I see missing from the discussion is, for example, nuclear. But then I risk getting myself now into a political rather than economic discussion. But I was influenced very much by a documentary that I saw about Bill Gates' efforts to develop what he called safe nuclear. And I think that what is discussed in the media frequently about nuclear, there's this perception of the risks of what we saw in Chernobyl and all those other accidents, and that, but the technology has actually moved on considerably in the last 40 or 50 years. But it seems to be not one that is discussed, but would be seems to me an easy one. But sorry, it was another point that there was another.
No, my point is that how much this aspect is considered, going back to the financial stability perspective. Also in the climate stress test and all these ideas of looking to the impact that this this energy crisis might generate and will generate, depending also on the policy that we are doing in terms of environment, on the balance sheet of the banks.
I think that the way that we have thought about, the role of macroprudential policy, prudential policies in all of this is that, you can't, use the risk management framework for banks to be the lever that is going to give impetus to this transition, but rather have the banks appropriately price and quantify the risks as this transition either to the hothouse environment or the other one. Both, there are costs going in either direction, as you know, Loriana. The transition to a net zero economy, of course, will impose some costs, but it's better than the alternative, which would also carry costs with it. But I think that we have the approach that we've always been taking to that is that the banks should be managing those risks so the risk weights should reflect, that there are certain industries that, this whole concept of stranded assets, for example, assets that are not, valuable anymore because you go to a transition to a totally different. That needs to be that risk needs to be managed well.
Okay, the last, we are already out of time, but I have the last question about crypto assets, so I'm changing the topic. Can you provide just a comment on what we just see in the market in the last, let's say, few days? At least I'm giving my view that, given that it's true that there are a lot of family householders that are holding it, but clearly it has to be a tiny amount, because pretty much the crash were enormous in several of these type of crypto assets, but we don't see any significant problem in terms of financial stability. Am I right, or
Well, I haven't seen any. Yes, I was trying to get up on my screen here. The Bitcoin price over the last 5 days. It's been phenomenal. You've gone down from 30,000 to 22 in the last 5 days. So that's a sizable correction. I think one thing that this is market development, and it's something that we had. I don't know if we had published it in the FSR, but one argument that people had been using for a supportive factor for Bitcoin as an asset is that it had diversification properties in portfolios, in the same way that gold used to. Gold used to be a zero. I think it used to have a zero beta, or close enough to. So it was perfect for reducing the volatility in a portfolio. But I haven't done the analysis, but I'm sure the correlation between Bitcoin and the S&P 500 is. Must be around 0.8, 0.9, something like that. So I don't think you're getting those diversification properties anymore. It was, others thought of it as the portable gold, but it looks like it is just subject to the same risk on, risk off factors that have been affecting markets more broadly lately. It's not going to cause a financial stability problem usually, Loriana. Okay, people will lose wealth, but what you want, in those situations, what you want to avoid is the domino effect that your loss of wealth means that you're unable to repay a loan, let's say, and then that puts the lender into difficulty, and then you get this kind of chain reaction. As long as you don't have leverage, now we have been seeing some signs of leverage emerging, and availability of leverage in the market has been increasing. Derivatives even exist, but we still don't think it has reached a point where it could cause a systemic event.
I'm sorry, there is the last question. I'm just taking the last one. The idea that transition risk is, it might create, in some sense, a sort of systemic risk. So a shock that, in some sense, will affect both banks and non-banks, including insurance and pension funds. So that is, in some sense, the question is how to decide between, how can you, in some sense, distinguish between banks and non-banks, including insurance and pension funds, for transition risk? Do you think that there is a significant difference?
Oh, that's a very interesting question. I mean, I was going to just say, I mean, the transition risk, it's all about the time interval during which transition risk takes place. And, you know, the climate risk has got this whole issue around it, like Mark Carney described it as the tragedy of the horizon. There is, I mean, it's a bit like, you know, the smoker who doesn't want to give up, who doesn't want to stop smoking until it's too late. I mean, I think transition risk only becomes a big issue from a financial stability point of view if it has to take place in a very short period of time. So, you know, all policymakers around the world throw up their hands and agree and admit, yeah, actually there is an issue globally and we have to do something. But they do it, you know, so late that maybe it's even too late, that they, you know, you can't reverse, and then it's a problem for it. But if the transition is, you know, over a protracted period, I mean, I think that, you know, but that's a responsibility of governments really, to ensure that it takes.
So you don't see a systemic risk be attached to this?
It could become a systemic risk if it was over a very short period of time, and where it's disruptive, where there are frictions, there's costs and so on, that it's you know, I mean, we've already seen, and I think COVID, the war, I mean, we're learning a lot about supply side shocks now, aren't we? And I mean, if we have a, you know, this is potentially a supply side shock issue as well. It's a transition, and it's a transition in the real economy from one sector to another or whatever. I mean, that could be disruptive if it's done over a very short period of time.
Okay. So, John, I think that we are 6 minutes after the time, so we are late. Thank you very much. I will go on, you know, for hours, as you know. And, you know, we are clearly planning to have another meeting like this in November. So, you know, enjoy the summer and see you later on. Bye-bye.
Bye-bye. Thank you very much.
Thank you to everybody, for the participants. Bye-bye.